What's up, millennials? Today we're going to take a look at the valuation of a company called UpHealth. And this company is a healthcare company that is going to be acquired by the SPAC that's currently trading under the ticker symbol GIX. Now, before we start, if at any moment in this video you're like, what the hell is this guy talking about? Please check out my SPAC guide. It's going to be in the description. We're going to be talking about method number 2 in this video. Also, if you need access to the Excel sheet I'm going to be using today, you can join our Discord. It's for free. You can just go to nesami.com/discord, leave your name, leave your email address, and you're going to get access to it. And lastly, as always, don't trust me, verify me. I'm just documenting my journey here on YouTube. I'm not a financial advisor. If we take a very brief look at what UpHealth is exactly, well, it's an integrated telehealth platform. It's a little bit like a baby Teladoc, if you know that company. They already have proven solutions on the market. They already have revenue as well. They had $115 million in revenue in 2020, so that's pretty good. And with regards to the merger, we're not entirely sure just yet when that's going to happen, but it is going to happen probably at the end of Q2. The merger was actually due on the 10th of March, so that is actually, for me, it's tomorrow, but for you, it's probably yesterday because I'm recording this on Tuesday and the merger is going to be extended tomorrow, so on Wednesday. So yeah, then the merger is going to be delayed a little bit and it's probably going to happen somewhere in June, I believe. Then if we take a look at the pro forma valuation, we can see that they started trading at $10 per share, just like almost all the SPACs out there. And we can also see that the total equity value, so the pro forma market cap basically, is a little bit over $1.3 billion. So that means that they're going to have, well, this number, 135.6 million shares outstanding after the merger. And that is going to give us this market cap, so that's the same number as over here. And we also see that they're going to have $1.2 million in net cash. Now, it's a little bit confusing in the investor presentation. I believe they made a few small errors because of like some copy pasting errors possibly. But if you take a look at the net cash on the left-hand side here, we can see that they're going to have $256.2 million in net cash, and they're going to have $255 million in convertible notes. So if you take that amount of net cash, subtract the amount of convertible notes, you're going to be left with $1.2 billion in net positive cash. So that's the number that I put over here in my Excel sheet. So that would mean that you could take that market cap and subtract the amount of net cash to arrive at an enterprise value of $1.355 billion. But in the investor presentation, it's slightly different, slightly lower. So that might be a little mistake on their end. Or maybe it's just me, of course, maybe I'm making this mistake here. But if we look into TradingView, we can see that the current price per share pre-market is $10.05, as we can see over here. So $10.05, that's the price we are going to be working with. It's just a very slight increase, of course, but that does mean that the market cap goes up a little bit to this number over here. And that means that also the enterprise value goes up slightly a little bit to this number over here in the Excel sheet right now. But that is, of course, the current pro forma market cap. We want to know what a fair price per share is going to be for this company. First of all, to get to that fair price per share, we need to take a look at what a fair enterprise value for this company would be. So what the company would actually be worth if you compare it to different companies, similar companies in the same sector. So we're going to do exactly that, and we're going to need two numbers for this. First of all, we're going to need a revenue number. In this case, we're going to be looking at the revenue, expected revenue, of course, of 2021. And then we're going to apply a certain multiple to that revenue to arrive at a fair enterprise value. So let's first take a look at the revenue of 2021. And that's going to be fairly simple because it's right here in the investor presentation. Of course, keep in mind this is an expected revenue for this year. It's not necessarily going to be this revenue number, but it is expected to be $194 million. So that is the number you can put over here in the Excel sheet. And then the only thing we need is a fair multiple. For that, we're going to go to page number 47 over here. And here we can see the revenue multiples of UpHealth. We can see that it is 7.2x. And we can compare this to the other companies out there. Companies like Amwell, Hims, Teladoc, OnTrack, Health Catalyst, etc., etc., etc. So we can see that UpHealth is generally lower. The multiple of UpHealth, 7.2x, is generally lower compared to the other companies that are displayed on this page in the investor presentation. And we can also see that the mean multiple of these companies, of these similar companies out there, is 17.6x, which of course is quite a bit higher compared to the current multiple of UpHealth. The thing, however, is that UpHealth is a smaller company if you compare it to especially Teladoc and Ping An and Oak Street Health, for example. You can see that the current enterprise value is, of course, 1.4 billion, and that's way lower than the other companies that are listed in here. So it's almost one of the smallest companies. So the question is, what is a fair multiple for UpHealth exactly? We don't know for sure, of course. We can just go ahead and we could make a range based on the mean multiple of this peer group. But you might also say that that is a little bit too high because UpHealth is a slightly smaller company compared to all these companies that they are comparing themselves with. So you could make the case that we need a lower multiple. But for this valuation, we are going to go with that mean multiple of 17.6x, and we're going to build a range of multiples. We're not just going to go with that 17.6x multiple, but we're going to use a range of multiples, 15x on the low end, 19x on the high end. So those are the multiples we are going to be using to arrive at a fair enterprise value. And again, you can choose lower multiples if you would like to do that, if you think that UpHealth doesn't deserve a multiple range of 15x and 19x on the high end. So if we then go into our Excel sheet, the Excel sheet is basically going to calculate the rest for you. What it's going to do is the following. First of all, it's going to determine the low enterprise value based on that revenue of 194 million in 2021. And it's going to apply that low multiple of 15x to arrive at this enterprise value over here of $2.9 billion. Then it's also going to do exactly the same thing for the high valuation. So it's going to take that multiple of 19x, going to multiply it by the revenue of 2021. And then you're going to arrive at a high enterprise value of $3.7 billion, more or less. Then if we scroll up a little bit, we can also see that the midpoint valuation, which is basically the average between the low enterprise value and the high enterprise value, is $3.3 billion. But that, of course, is the enterprise value. We want to know what a fair price per share is. Well, first of all, what we need to do is to go back to a fair market cap. And we said in the beginning of this video, the difference between the enterprise value on the one hand and the market cap on the other hand is the amount of net cash they're going to have on their balance sheet. And we said that was going to be 1.2 million. So of course, not that much compared to the enterprise value. So the difference is not going to be very large. So as we can see, the market cap is basically almost the same compared to the enterprise value. So again, for the low end, 2.9 billion. For the high end, 3.7 billion. For the midpoint valuation, 3.3 billion. And then the only thing we need to do is to take these market caps and divide them by the amount of outstanding shares after the merger, which we said was going to be 135.6 million shares outstanding. So if you do that, if you take these market caps, divide them by the amount of outstanding shares, you're going to arrive at these fair prices per share. For the low end, you would arrive at a fair price per share of $21.47. For the high valuation, $27.19. And for a midpoint valuation, $24.33. But of course, again, keep in mind, we haven't taken a look at a revenue multiple, of 15x on the low end, 19x on the high end. You could, of course, decide that this is a little bit too high. Maybe you want to go with a lower multiple range. Maybe you want to go with 10 on the low end, 14x on the high end. And then your fair prices per share are going to change as well. So you can just play a little bit, play around a little bit with the multiples. You can change these multiples to see what kind of multiples you think is fair. But again, if we go back to 15x on the low end, 19x on the high end, we can see that a midpoint fair price per share is $24.33. So based on these calculations, that would mean that UpHealth currently is actually undervalued. Of course, don't trust me, verify me. I'm just documenting my journey here. I could be completely wrong. And also take into account, we have been taking a look at assumptions. So we've taken a look at an expected revenue for 2021. We've applied a certain multiple, which you can change, of course, if you think that is too high. And if you change one of these numbers, the entire calculation is going to change and your fair price per share is going to change as well. With that being said, thank you very much for taking the time to watch this video and I hope to see you in the next one. Bye-bye.